Welcome, everyone. Today, we're going to pull back the curtain on one of the most important financial documents you'll ever analyze, the statement of cash flows. Now, we're not just going to be looking at a bunch of numbers. We are going to uncover the story of how a company actually finances its biggest dreams, its most ambitious growth. For you, as the future leaders and strategists in the room, getting a handle on this is, frankly, non-negotiable. It is the absolute key to understanding a company's health, its strategy, and its very future.
So, let's kick things off with a scenario that I guarantee you will face at some point in your career. Picture this. You're part of a team, you've got a game-changing idea, a product that could reshape the market. The problem? Your company's bank account doesn't have the cash to make it happen. Now, this isn't just some textbook hypothetical. This is the fundamental challenge that defines almost every business, from a tiny startup in a garage to a massive global corporation. The question is always, how do you fund the future?
And to answer that, we've got a pretty clear roadmap for our lecture today. We're going to start with what I call the capital question. Then we'll dive in and decode the language of financing activities. From there, we'll apply what we've learned to a case study so you can see it in action. Then we'll learn how to analyze these statements like a seasoned pro, and maybe most importantly, I'll walk you through the common traps that students and professionals fall into. So let's get started.
All right, section 1, the capital question. I really need you to shift your thinking here. Accounting isn't just about tallying up what happened last year. It is the blueprint for building the future. And every single brick in that future, every decision, is laid with one critical ingredient: capital. I mean, just think about it for a second. You want to hire the best software engineers in the world? That takes capital. You want to build a brand new state-of-the-art factory? Capital. You want to launch a massive global marketing campaign? You guessed it, capital. It really is the lifeblood of any organization. So understanding how a company gets and uses this fuel is absolutely fundamental to understanding its entire strategy. So, where in all those financial reports do we find this incredible story? Well, we find it in the last section of the statement of cash flows, in a part that is dedicated exclusively to financing activities. This right here, this is the official record. It's the logbook of a company's entire funding strategy.
Now, the textbook definition here is crucial, so let's break it down. Financing activities track the flow of cash between a company and the two main groups who give it money, its owners and its lenders. It's a two-way street. You have inflows, which is cash coming into the company. That's what happens when you sell stock or you take out a loan. And then you have outflows, which is cash going out of the company, like when you repay that loan or you pay a dividend back to your shareholders. So when the money a company makes from its day-to-day operations just isn't enough to fund its big, ambitious growth plans, it has to look outside the company for cash. And broadly speaking, there are two main paths to take. And let me tell you, the path they choose is one of the most important, most consequential decisions that a management team will ever make.
And here are those two paths. First up, we have debt financing. The easiest way to think about this is it's a loan. A bank or a lender gives you cash, and in return, you create a liability on your books, a formal promise to pay that money back, plus interest. The key here is you keep full ownership of your company. A really important advantage of debt is that the interest you pay is usually tax deductible. This creates what we call a tax shield, which can actually lower the real cost of borrowing. Now, the second path is equity financing. With equity, you're not borrowing anything, you're selling a piece of your company. An investor gives you cash and you give them shares, which makes them a part owner. There's no legal obligation to pay that money back, but, and this is a big but, you've diluted your ownership. And let's be really clear about what dilution means. It means your slice of the ownership pie just got smaller because you've invited more people to the table. This is the classic trade-off. Do you want to keep control and get a tax break, or do you want to avoid a legal requirement to pay something back? Okay, to make this all concrete, let's trace the journey of a hypothetical company. We'll call it Innovate Co. By watching its financing choices over time, we're going to see how they reflect where the company is in its own life cycle. This is how we learn to read the real story behind the numbers.
Let's walk through Innovate Co's story. Okay, year one. They're a brand new startup. They're risky, they have no track record, no profits. A bank is not going to give them a loan, so what do? They turn to equity. They raise $1 million by selling stock to investors who believe in their long-term vision. Now let's jump to year 5. The company is now stable, it's profitable, a bank looks at them and sees a credit-worthy business. So, to build a new factory without giving up more ownership, the founders choose debt. They secure a $5 million loan. Year 8 is a huge milestone. The company is now so successful that it's generating more cash from its operations than it needs to reinvest in the business. So, they decide to reward their shareholders. They pay a dividend, a $500,000 cash outflow. This is a huge signal to the market that the company is healthy and confident about its future. And finally, in year 10, they start paying back the principal on that loan. That's another outflow, which reduces their debt, makes their balance sheet stronger, and improves their credit rating for any future borrowing.
The story of Innovate Co. really drives home a crucial lesson. These financing decisions, they're not just random numbers. They tell a strategic story. You use equity when you're young and unproven. You use debt when you're stable and established. And you start returning capital to shareholders when you're strong and mature. The financing section is a direct window into a company's life cycle and its overarching strategy.
Okay, so we've seen how this looks from inside the company. Now let's switch chairs. Let's put on our analyst hats. Because as a future investor or a lender or even a senior manager, your job is going to be to look at these statements and accurately interpret what they're really telling you.
All right, here's a critical thinking question that trips up so many students, so pay close attention. You open up a financial statement and you see a massive positive cash flow from financing, say $100 million. Your gut reaction is probably, wow, that's great, they raised a ton of money. But is that always a good thing? We have to dig a lot deeper than that. This little table right here is going to shatter that simple assumption. Look at the growth startup, a positive $12 million in financing cash flow. That is a fantastic sign of health. It shows that investors and lenders are excited and are willing to pour capital into the company to fuel its expansion. But now look at the mature blue chip company. It has a negative $13 million cash flow. Is that a red flag? Absolutely not. In fact, it's a sign of incredible strength. This tells us the company is so profitable from its core business that it doesn't need external cash. Instead, it's using its own profits to pay down debt and reward shareholders by buying back stock or paying big dividends. So you see, a positive number can mean growth, but a negative number can mean strength. Context is absolutely everything.
And that leads us perfectly into our final section, analytical pitfalls. I've graded thousands of exams and papers, and I've seen countless students make the exact same mistakes in their analysis. So let's make sure you're not one of them. Let's make sure you develop a much more sophisticated understanding.
The single biggest mistake you can make, and please write this down, is analyzing a number in a vacuum. A financing cash flow figure, all by itself, tells you almost nothing. You have to connect it to the broader context. What industry is the company in? How old is it? What is its publicly stated strategy?
And here's another one of those common traps. As a society, we're kind of conditioned to think of debt as being inherently bad, right? So it's really easy to see a company take on a huge loan and just assume it's a sign of weakness or desperation. But is it, really?
The answer, as it so often is in business, is it depends. It depends entirely on the story. I want you to think of debt as a tool, like a power saw. In the right hands, a power saw can be used to build a beautiful house. In the wrong hands, it can be very dangerous. As analysts, our job is to figure out how the company is using that tool. So how do we assess that? How do we figure out the story? We ask these 4 key questions. First, and most importantly, why? Why was this money borrowed? Is it being used to fund a new, high-growth product line? Or is it being used just to make payroll because the main business is losing money? The first reason creates value, the second destroys it. Second, what's the interest rate? Is this cheap, smart capital, or is it a high-interest loan of last resort? Third, what's the return? Smart companies use what we call positive leverage. They borrow money at, say, 5% and invest it in projects that they expect will generate a 15% return. That's how you create shareholder value. And fourth, can they afford it? Can their regular operating cash flows comfortably cover the new interest payments? A quick look at a metric like the debt service coverage ratio will tell you a lot. So, here it is. A simple 3-step framework that will guide your analysis every single time. Step 1, identify the source. Is it debt or equity? Make sure you understand the trade-off they decided to make. Step 2, analyze the use. Is this cash going toward a productive investment that will grow the company, or is it just for survival? And step 3, connect to strategy. Does this financing move actually make sense with the company's overall strategic plan?
Okay, let's bring it all home. If there is one single thing I want you to take away from our entire discussion today, it's this.
When you look at the financing section, I want you to see more than just a list of transactions. I want you to see a narrative of trust and of confidence. When a company successfully raises capital, it's making a statement to the entire market that it has a future worth investing in. And when a company successfully returns capital to its investors, it's making a statement that it is delivered on its promises. It is the story of the fundamental relationship between a company and the people who fund.
So I'll leave you with this final thought.
We've spent our time today learning how to read this critical financial story, but very, very soon, you will be the ones who are writing it through the decisions you make as managers, as entrepreneurs, as investors. So the real question is, now that you have this knowledge, what story will you write?